Welcome to another episode of Quest for Twice. Today is September 13th. The second quarter earning season has ended, so today I'm going to cover updates from several major technology companies. The first one is Google. Google has two most important business segments. Let's look at the Google Cloud first. That's shown in the figure on the top right. We can see the quarterly revenue had a steady increase to about 29% year-on-year growth. That's about the same as 1 quarter ago. So we haven't seen any acceleration due to adoption of generative AI applications. Then let's look at the moneymaker, Google Services. So that's shown in the figure on the bottom of the slide. It has a lot of bars and lines. The gray bars are the Google Services revenue, and the yellow bars are the Google Cloud revenue. So it's more informative to look at the lines. There is a dark green line, that is the Google Services revenue growth rate year on year. So if we look closely, we can see that the growth rate bottomed out in the fourth quarter 2022, then picked up and reached the top growth in the fourth quarter last year and the first quarter this year, then had a gradual deceleration, but still above 10% in the second quarter. I also plotted the growth rate for Amazon advertisement as well as Meta revenue growth, so we can compare. So we can see the Meta growth rate during the pandemic was similar as Google services, but had a earlier and faster decline in 2022 and a faster bounce back in 2023. Interestingly, Meta's revenue also peaked in the fourth quarter last year and the first quarter this year, and had a slight reduction in the second quarter. And comparing to Amazon ads, very similar story, just a different magnitude. We see a deceleration since a peak in the fourth quarter last year. So I'm going to get into Meta's revenue on a later slide. So for now, the key takeaway is the digital advertisement is decelerating in revenue. In terms of profitability, that is the Google service ops margin represented as the red line. We can see that it stayed high around 40% in the last 2 quarters. That's a pickup from a low of 30% in the fourth quarter 2020. So it's still very profitable. Now let's look at the Google valuation level at $150 per share. Its EV over ops income is about 18 on the unadjusted basis, with adjustment to take into account the potential profitability of a Google Cloud. That number is about 14. Both numbers are located near the low end range before pandemic, and but still higher than 2022 when Google stock was on sale. So what are the risks? The first one is at the market slowing down during recession, and we can already see a deceleration in the recent quarter, mostly due to the slowing down of the economy. Another one is ChatGPT steals market share and advertisement dollars from Google. A new threat that recently materialized significantly is the antitrust lawsuits from both US and European regulators. The worst case would be leading to a breakup of the company. And there is a opportunity of a Google gaining cloud market share and leveraging its AI expertise. Now let's look at Amazon. In the second quarter, Amazon grew its revenue by 10% year on year. That's a deceleration from previous quarters, but still within the guidance range issued 3 months ago. For the third quarter, the guidance is about 8 to 11% growth. That's similar as the second quarter. AWS grew 19%. That's an acceleration from 17% and 13% in the 2 quarters prior. As I mentioned earlier, the ads segment is decelerating from a high level at the end of last year. The 1P and 3P sales were up 5 and 12%. Now let's look at the margins and cloud business more closely. Its quarterly ops margin was about 10% versus 5.7% 1 year ago. That's drastically helped by cost reduction. For example, if we look at the COGS as a percentage of revenue, that's shown in the figure on the top right. We can see the COGS has been declining from a peak in fourth quarter 2020 and trending downwards continuously. Similarly, its fulfillment cost peaked in the first quarter 2022, then started the downward trend, but looks like it has stabilized. Of course, the most profitable segment is AWS. Its ops margin was 36% in the most recent quarter. That's shown as the dash line in the figure at the bottom right. I also plotted the revenue growth for the 3 major cloud providers: Amazon, Microsoft, and Google. We can see generally they trended down from a peak during the pandemic, bottomed out in 2022, then rebounded last year. But in the most recent quarter, Microsoft's Azure revenue growth actually decelerated from the previous 3 quarters. Google Cloud was holding steady, and Amazon AWS increased its growth rate slightly compared to the first quarter this year. So overall, there is a limited sign of accelerated AI demand for the high power computing the 3 companies have been providing. Next, let's look at the Meta platforms. As shown in the figure on the right, the second quarter revenue was up 22% from 1 year ago. That's a deceleration from first quarter and the last quarter of last year. The third quarter this year revenue growth of 16% is a further deceleration. The bright spot is ops margin of 38% compared to 29% 1 year ago. So if we look at the figure, the yellow line is the quarterly R&D expenditure, and the blue line is the total ops expenditure. So we can see that those expenses continuously grew until about the end of 2022. Then both expenses held roughly steady in the last 1.5 years. In the meantime, the revenue has been growing since 2022. As a result, the ops margin bottomed out in the second half of 2022 around 20%, then reached a high near 40% recently. So for this year, the management guided the total expense close to $100 billion. That's almost $10 billion more than the 2022 or 2023. Also, in this year, capex will be at least $10 billion higher than last year. So it looks like the expenses will be going up again. That's because of the AI opportunity, and Meta is investing heavily in the AI computing power. Now let's look at the valuation and the risks. First, let's digest the figure on the right. This figure, I plotted the Meta's revenue from advertisers located in different regions of the world, including APAC, USA, Europe, and the rest of the world. I also plotted the year-on-year growth of the revenue from those different regions. So let's look at the overall revenue growth. That's the dotted line. We can see the growth rate bottomed out at a contraction of almost 5% in the second half of 2022. Then that picked up very quickly in 2023 and reached the peak in the first quarter of this year above 26%. So what's going on there? I believe the fast growth is a distortion by several factors. The first one is the APAC region. Chinese economy reopened in 2023 after COVID lockdown in 2022. That explains the very fast APAC growth in 2023, represented by the green line. But we can see that peaked in the second half of 2023 and has been dropping very, very quickly. In the second quarter, the growth rate was just over 26%. And for Europe, the growth rate was represented by the red line. We could see it had a severe contraction in the second quarter through fourth quarter 2022. Then it bounced back in 2023. I believe the contraction was due to the Russian invasion of Ukraine in 2022. And as a result, it shocked the European economy. And in 2023, European economy had a much easier comp, so we could see that very fast bounce back. But the easy comp was over, so we could see in this year the European revenue growth has been decelerating. Lastly is the US growth. It contracted for about 5% in third quarter 2022. One of the main reasons was because of the Apple changed its privacy setting and severely limited the effectiveness of Facebook's advertisement. But afterwards, that effect has worn off, so we could see revenue enter the growth mode again in 2023. But interestingly, it peaked in the first quarter of this year and started a decline in the second quarter. So I believe 2022 was a perfect storm in terms of Meta's revenue. Then 2023 was a bounce back year. 2024 will be a normalization year. So now with that context, let's look at the valuation. At $511 per share, its PE is about 26, and EV over EBITDA is 17.6. Those are fairly rich levels for a business that's having decelerating revenue growth. However, that reflects the optimism related to artificial intelligence. So I do see Meta AI, which is called Mag4, as well as WhatsApp as a distribution tool, presents quite a bit growth revenue opportunity in the future. But it's hard to say when that opportunity will materialize. So the main threat is Meta may be wasting huge amount of capex on data center as well as metaverse, and also expenses may reaccelerate again with more D&A with a high capex expenditure as well as more AI related R&D with more high capex. The next major tech is NVIDIA. As shown in the figure, its revenue, which are the orange bars, had explosive growth in 2023 and continued its fast growth. But because of the law of a large number, its quarter-on-quarter growth rate peaked around 90% in July of last year, then had a fast drop-off. In the most recent quarter, its quarter-on-quarter growth rate was just over 11%. Also interestingly, its gross margin, represented as a red line, had a decline from a very high level in the first quarter. The management blamed on production issues related to its next generation GPU named Blackwell. So overall, I would say NVIDIA has a very fantastic business. However, the price is at the no split level because its price over gross profit is 32 at $117 per share. It's using a normalized run rate revenue from second quarter revenue. I would say that's a price for perfection given the deceleration of recent quarterly revenue growth. Of course, it may still work out if the AI is a great productivity enhancement tool as the investors currently expecting. However, if there is any disappointment there, then NVIDIA's stock price will be very vulnerable. The key question now, besides the continuous AI demand and application, will be the next generation GPU Blackwell. Will that reboot the growth and the margin? Now let's switch gear, look at the Mercado Libre. The most important figure on this slide is the one on the top right. It shows the revenue of Mercado Libre's different segments in the last 3 years. It has quite a bit of information, so let's look at the shaded area first. So the gray area and the orange area combined is the e-commerce business revenue. It just continued to grow very fast. On the fintech side, the purple line is the credit revenues. We could see after stagnant in 2022, it resumed growth. And the brown line is the total fintech revenue, it also continued its recent strong growth. On the margin side, its gross margin stabilized after accounting changes related to shipping revenue. So overall, the growth momentum just remains strong and continued. Let's look at the fintech side more closely. The last quarter sales was $2.1 billion. A big part of it was credit portfolio growth, as shown in the shaded areas in the figure on the bottom right. The net interest margin after losses was stable from first quarter of this year. So the company was growing its credit book profitably. Lastly, let's look at the take rates. The left side the figure was the commerce take rate. If we adjust the shipping fee accounting changes, then the second quarter commerce take rate 23.5% was similar as first quarter as well as 1 year ago. Fintech take rate in the most recent quarter was 4.4%, 4.5%. So was stable from first quarter of the. So overall, the investment thesis has not changed. A very fast growth company with a wide moat and a fair valuation level, given that at $2,100 per share, its price over sales was 6.2 versus 14 for Amazon.com before the pandemic. This concludes this episode of Quest for Twice. Until next time, happy investing.